How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And what we're going to go into is Market Mondays for 5/17/2021. So we get into like the second, maybe third week of May. It's been a very volatile May. And so we're going to kind of break that down and give you a basic understanding of what's going on in the market and try to put you in a position where you can be successful operating in the market. You can be potentially profitable. We can't guarantee you that. And one of the reasons we decided to do this show is to give you a basic understanding of how the market can help you accomplish some of your goals as an individual person or as a member of your particular group. Give you a market-based conversation that's going to be very concise. It's not going to be very long-winded. We're going to get to the point. We're going to give you the meat as opposed to a lot of the dressing, and it really try to help you understand what's going on. And we want to give it to you in a very, very common tongue to where you don't feel like you got to be a person on CNBC or CNN with a suit on. You got to have a PhD. You got to have a background, a long, extensive background in maybe finance and economics and mathematics. We didn't want you to have any of those hangups. So that's kind of what we really decided to do. And what we're going to do is we're going to go into Market Mondays for 5/17/2021. Want to really encourage you and ask you to like the video, share the video out, let somebody know about it. We're continuing trying to build the channel and continuing to try to attract people that want the particular value that we'll bring it to the table. So let's go ahead and get into it. So today, market came out kind of lukewarm, turned red as the day went on. And we talked about the narrative or the colloquialism for this month is sell in May and go away. There's a lot of volatility. The market was green Friday after about 3 or 4 days of being red. We saw the market go red today. So we were going to kind of observe and try to determine whether or not we're going to get more volatility. I could anticipate the market probably being back and forth the rest of the week because it wasn't really down. The red wasn't really, to me, very severe, but it was enough to where the market never really found its momentum from a bullish standpoint. The 10-year treasury was around 1.65%. And we were talking about before, a lot of people have become desensitized to that. There was a time in which around 1.6 sold off the whole market. So we're going to continue to observe that. Fed minutes is going to be released on Wednesday, and we're going to get info on the Fed continuing buying bonds that create a floor for the particular bond market. So the Fed is buying bonds at a really, really rapid rate. They're not creating all the demand in the market, but essentially become the buyer of last resort to make sure that that market has the liquidity that it needs to operate and make sure that people have confidence in the market by them telling everybody else, well, we'll buy the bond, so the bond must be good. So if the Fed comes out and says that they're going to discontinue that program to buy those bonds, it could cause a really, really bad reaction in the market that may last a few days. But I don't think the Fed is going to stop their behavior. Because I think the Fed pretty much says that they're going to maintain this particular course of buying bonds and keeping the interest rate really low until they decide that the economy has fully, really recovered. Right. So let's go ahead and continue to observe that. Now, let's look at some jump outs. We're going to talk about some companies that did well and maybe didn't do well, give you some context and really give you something to talk about and give you something to take back to your groups and kind of observe them so you can get a better understanding of how to analyze maybe a specific company or maybe a specific index. So we're looking at crude oil. Crude oil was green today. It finished the end of the day probably relatively strong. And what we want to look at is that we talked about energy as a sector being very bullish as we get closer to summer. And we might start seeing that change or maybe because of some instability in the Middle East. But what we want to do is continue to observe that. But we anticipate that crude oil is going, I'm not crude oil, but energy, the energy sector is going to be very, very bullish as we get closer to the summer months. Now let's look at SPDR Gold, GLD. I believe this is an ETF. It did fairly well today. This particular ticker doesn't move really, really strong. It's not a rapid mover. It's been kind of down on the year. I remember one time this thing was like around 190. Last year in August, I made a lot of money on this particular ticker, like a lot, because of the way it was moving in response to a lot of the monetary policy from the Federal Reserve. It hasn't really done that well, which is unusual based on the current monetary policy. But we're going to continue to observe that because maybe it might finally start to be turning around with the whole metals industry. Now, let's look at barrickgold. This is a gold miner. It also did pretty well today. It was up around 5%, $1.25. And also it performed really, really well. We want to continue to observe, precious metals and also the miners of precious metals and try to determine maybe they're going to start a bullish run as this federal monetary policy starts to become more and more extended and pronounced. And we start to understand that they're going to pretty much stay on this path for an extended period of time. Now, let's talk about our topic of the day. And this is something that is relative to what we're currently seeing in the market. It's called sector rotation. So this is kind of, I would say, a more of an economics, more of an economics discussion. However, I really am a believer in that you have to understand basic economics to understand the market, because the market is a byproduct of a basic economic theory and also basic economic laws. So what we have is a lot of people trying to understand the market without understanding the kind of the fundamentals of an economic model or just basic supply and demand economics. So one of the things that a lot of people have been dealing with is sector rotation, but also in regards to seasonality. So when you're looking at the particular stock market, you're operating in with multiple variables going on at the same time. You have, seasonality, but you also have individualized, what I call binary events, where they're all happening at the same time. And you got to kind of try to figure out, what do you believe is going on from an overall standpoint, and then break it down to a micro standpoint. So let's look at this particular example. Now, I don't want you to use this example as like law. I just want you to use it as an example for how we can structure this to get a basic understanding. Because sometimes if we get a visual, it can kind of cement in our head what is actually going on. So we're looking at blue is going to be the economy. Red is going to be the market. OK, so blue is the economy. Red is going to be the market. So what we're going to do is understand, when you're looking at the stock market, a lot of times it leads the overall economy, which what I mean by that is a lot of times it may be ahead of what's going on in the overall economy. So often the stock market would drag the overall economy with it. However, the overall economy can really affect the market. So the market can respond to something that's going on in the overall economy. And then what it'll do now is it'll have a negative or maybe a positive reaction to it. And then what that can do is drag the overall economy in that particular direction. So if we're looking at from the far left, we're looking at the market bottom. When we're looking at the market bottom, right, as the economy starts to go down, what we're seeing is a lot of times going to be down is finance, technology, and cyclicals. I've always have an issue pronouncing that. So it's cyclicals. So when the actual economy is going down, as it's starting to approach into a recession, so we're starting to see some of the early indicators of a recession. What a lot of times may be at the bottom, let's say in this particular example, can be finance, technology, and cyclicals, right? So then we start to hit what we call the trough or the bottom of that recession. We will often see technology, industrials, and basic materials start to go into a bull market. OK, as we start to go into an early recovery stage of that particular economy, we may see, right, as the market starts to top out or plateau, basic materials, energy, and staples start to become really, really hot. Right. Then as we start to go into a full recovery or a plateau in our particular economy, we start to see energy and staples and healthcare potentially go into what we call a bear market. Then as we start to go farther into that bear market, we start to see fair market from a market standpoint. As we start to go into an early recession from an economic standpoint, what do we start to see? Right. Healthcare, utilities, and finance start to become affected. So what happens is this just continue to rotate over and over again. So when you're looking at the particular economy and people are saying that, well, people are rotating out of tech. Well, why do you think they're rotating out of tech? Well, the question you want to ask yourself is, why do you think people are so bullish on tech a year ago? So what we saw when COVID really became real in the actual overall economy, we saw a lot of money in the actual market kind of being propped up by tech, so that everybody became a proponent or bullish on tech. The question I have to ask you is that, well, where were you a year ago? Because everybody's not talking, well, when that particular situation happened, everybody was talking about tech. Okay, so where were you a year ago in regard to these same exact companies, right? Because people weren't really talking about ETFs. They were more talking about individualized companies. So where were you 5 years ago in regards to these individualized companies? Because these were not like fly-by-night operations. Then what we saw was the EV space started to get really, really hot. A lot of speculative EV space, which is a byproduct of maybe technology, right? So now we're seeing a lot of money flow out of those particular spaces into other, right, areas of the economy or other areas of the market, right? Now, a lot of people don't understand what is going on is because they really don't understand sector rotation. OK, so what you have to understand is that a lot of these big funds, they don't just have fund managers working for them. They don't just have traders working for them. They also have economists. They have people that kind of like understand trends, and they kind of look to try to figure out, where do we think the overall economy is at? And where do we think consumer behavior is going to start becoming strong or weaken? And then how do we need to allocate or manage our portfolio in regards to that? Now, these type of conversations to the average person are very, very boring, and that's cool. However, once you start to really understand these things is how you put yourself in a position to really make a lot of money in the market. So one of the things that I really want to encourage you to do is start having conversations that can be a little bit more robust than just this company's hot right now. And so therefore, I want to put my money in this particular company. But then when that company's not hot, right, you don't know what's going on. And it's your money. You can do what you want to do with it. But I really want to encourage you to kind of challenge yourself to really understand this from not just a micro level, but from a macro level, and to be able to go back and forth. So there's a comprehensive understanding that you can have over the overall market and overall economy. And you can kind of break that down to a micro level and just challenge yourself to have that understanding to where you can have a conversation with somebody about it. Doesn't mean that y'all have to agree. You can have two economists that can disagree on where the actual economy is from a recovery standpoint, right? You can have two different analysts that can agree or disagree on their price target for a particular company. However, because they really understand what is actually going on from their perspective, they can have a conversation about it that can lead to a better understanding for the other person, to where now I can take that information, apply it in my particular market-based activity, and figure out a way to go make me some money from it. So I'm not into you having a discussion just for the sake of having a discussion. I'm here for you to try to get a better understanding, so now you can apply this to what you're doing and figure out how you can make money from it. Because as the market starts to rotate, you have to be able to understand the rotation and then take you and your group and put you and your group in a position to be able to monetize the rotation, because the market rotates all the time. So what you see with a lot of the bigger funds is that they don't necessarily, you do have long-term holdings, but they also can rotate in and out of things based on sector rotation. So they may figure, hey, we've made our money in this particular area. Now it's time to take that money out of that area and put it somewhere else so we can get a better return. Then once they make their money there, let's put our money somewhere else so we can now get a better return. So it doesn't just mean that they're going to just put their money in a company and they're going to kind of shoebox it till infinity. Now, I may do that, but that doesn't mean they're going to do that. And one of the things that you got to separate yourself from is that your reason for investing and your time horizon may be different than somebody else's. So when you're following somebody else's trades or investments without you knowing their time horizon, when they get out, you can get left holding the bag because you and that person don't have the same time horizon. So you as an individual investor got to determine, why have I invested in this company? What is my time horizon? How will I deal with the fact that this particular share price can fall as people start to move out and take profit and move into another area? Will that shake my resolve in the company? Will it shake my faith in the company? And then how will I deal with that? As an options trader, you always have to factor in seasonality to this particular company. So that overall sector or that overall industry may deal with seasonality. If you have long-term plays, or even if you have short-term plays, how does seasonality, right, or sector rotation deal with or take into regard your particular options plays? And if you haven't asked yourself that question, you maybe want to start asking yourself that question, because it's something that you can deal with and something that a lot of people have been dealing with, especially people that was bullish on tech since probably around the top of the year. So that's going to be Market Mondays for, I think it's 5/17/2021. If you have any questions, let me know. If you want to know more about the highest paid part-time job in the world options trading program, reach out to me. This is David W. Williams, also known as Diamond Dave. Like, share, subscribe, and I'll talk to you later.